What's up, everybody? It is the end of April, early May, so you know what that means. That means our first quarter market research results are out. What happened over the last quarter? Always interesting in the first quarter because you get some cyclical stuff going on in the market. We're here to tell you all about it. Check it out. So here at Buckingham, we do things a little bit differently. A lot of our clients like to buy those 2 to 4 unit residential properties that have 30-year fixed financing on them. It's really difficult to find research on that stuff from the big data research platforms like CoStar and other places that you might subscribe. So our solution to that, we do all of our own local market research. Our analysts comb through everything, they correct all the errors on the closed sales, and we publish every quarter a nice clean report into our market research dashboard that shows exactly what happened in the market, both in that 2 to 4 unit property space, as well as the 5 unit and above commercial multifamily space here in southern LA County. So always really interesting to compare the two, see where things are going. It helps me feel a lot better about the direction of the market. And this is a super micro level deep dive into what's going on here locally. This isn't just like citywide metrics that we have. We can dive right into the zip code level and the neighborhood level on this stuff. And if you want to reach out to a Buckingham agent, we can even give you all the individual properties that are in the comp sets for this data. So really interesting things going on right now in the market. It's a weird time, right? We've been in a downturn for just about 4 years now. Hard to believe, but we've made it. Here we are. For those of you still kicking, congratulations. Hope you've enjoyed those cash-in refinances. I know I have. Not really, but anyway, that's where we are. That's the reality. So always like to check with volume first. Volume in the first quarter was really low compared to the fourth quarter. That's pretty normal. A lot of people rush to get transactions done by the end of the year. And last year we saw that in an especially big way because we had the big beautiful bill that passed, which memorialized that bonus depreciation. And so everybody wanted to get deals closed by the end of 2025 so you could get those cost segregation studies done and lock in that bonus depreciation for tax year 2025. In the first quarter, everyone's kind of done with the holidays, they've got the hangover, they don't really want to buy, they're worried about taxes, and so volume's pretty low. Closings came in at about 170 closed transactions in the first quarter. That's about the same as it was in 2025, and a little bit of a recovery from 23 and 24 when volume had really fallen off a cliff. Still, we're considerably lower than we were pre-pandemic and in the super low interest rate days of the 2020, 2021, early 2022 pandemic days. So we're starting to see volume kind of come back a little bit, but it's hesitant and things have to work their way through the system. So it'll be really interesting to see what happens through the rest of the year to volume as we get into the second quarter and third quarter, which are often a busy time for transactions. Okay, so when we talk about investment property metrics and valuations, you have to think about the income approach to value, right? So that's cap rate and gross rent multiplier. If you're not familiar with those terms, check out some of the stuff on our website and some of our educational materials, but we'll assume you understand this stuff. So GRM in the first quarter came in at 14.2 across southern LA County. That's from about LAX down through Long Beach. And the cap rate was kind of about the same, 4.8, where it's been for the last couple quarters. So I would say we're sort of bouncing along the bottom of this cycle, or at least that's how it looks right now. We are barely improved from the quarter before. GRM is up by 0.1, cap rate is down by 0.1. So not a huge change there from the fourth quarter, but just the fact that it looks like perhaps the momentum has leveled off suggests that we may be in the very early phases of what will become a recovery later in this year and hopefully on into 27 as rates start to come down in a more meaningful way. Now, looking at this historically, you start to realize what a great deal you might have in front of you if you're thinking about jumping back into the market. If we carry our chart all the way back to the last time we were at these levels, you're looking at late 2013, early 2014 valuations as it pertains to cap rate and GRM. That's really amazing. So great time to get in for to anything. If you're thinking about maybe what it would have been like to buy some stuff in 13 and 14, for those of us that we're probably pretty happy with those purchases now, 13, 12 years later, right? Now, price per square foot, a little bit of a different story. That has not come down as much over the last 4 years as the income metrics have deteriorated, but by and large, investors have been able to capitalize on increased rents. People have executed on their business plans, and so price per square foot's down a little bit over the last quarter, but still even higher than it was in 2021 and 2022. So not that surprising if you understand what's going on in the rental market. That being said, the rents have been a little bit flat to even down down lately. So I wouldn't expect a lot of changes there. So price per square foot averaged a $479 per square foot price in the quarter. That's down a little bit from $491, but cyclically speaking, it's been basically flat here for the last couple of years, just down very slightly. So we'll see where that goes from here. Price per door, on the other hand, was actually up a little bit at $414,000 per unit. Now, I think that's probably explainable just because of the mix of sometimes you get more units selling in nicer areas or larger units selling. So we see that bounce around a little bit. That's also been pretty flat over the last few quarters. So we're looking for that to improve from here. I always like to pay close attention to inventory levels as well, as I think that's one of the best leading indicators that we can look at to suggest where the market might be going in the future. So in the first quarter, our average inventory level, that's the number of active listings in this area, was about 660. That's actually down a little bit from the middle of last year when we were up just over 800. So that's a pretty good sign for the market's health. It seems like buyer and seller equilibrium are starting to come back into balance. Whereas in summer of last year, we just had tons and tons of listings out there, very few buyers. And so we were kind of thinking that price might still deteriorate from there. Now we're looking at a couple quarters of stable prices. Inventory is down considerably from that level, and it seems to sort of be bouncing along. This moves a lot seasonally, so inventory was down considerably in December. It's back up as we get into February, March. I expect it to be back up again in April, just because that's when a lot of people list their properties to sell, time to make moves, and then we'll see that transaction volume tick up into second and third quarter from there. So inventory is pretty seasonal metric, but it's really interesting to see where it is. It seems like a lot of that has been absorbed over the last few months, and so we do kind of feel here in the brokerage business the equilibrium returning between buyers and sellers. Okay, now for the fun part. So we've been talking a lot about the difference between 2 to 4 unit metrics and 5 unit and above commercial multifamily metrics, and they are at their widest spread that we've seen since we started tracking the difference between these two parts of the market. We have commercial 5 unit and above in this area traded on the first quarter at an average of a 6.1% cap rate and 10.9 GRM. Those are really attractive numbers, especially when you roll that up. That means that there's deals happening considerably above even a 6% cap rate, depending on where you're looking. Price per door on average was right about at $250,000. Contrast that to the 2 to 4 unit properties that have that lock-in effect, the 30-year money, fixed rate mortgages, much, much more expensive. Average GRM there was 15.2, average cap rate was 4.4. That's 170 basis points of spread in cap rate and over 4 multiples in GRM. That means if you have a 4 unit sitting right next to a 5 unit in the same market, all other things being equal, that 4 unit is worth 4 multiples of annual gross scheduled rents more than the 5 unit. Hard to believe, but that's actually what it shows when we kind of compare the data between these two categories. Price per door on the 2 to 4 unit stuff as well, way more expensive than the 5 and up, clocking in at just over $450,000. So that's $200,000 more per unit to buy those smaller properties than it is to be in the 5 and up multifamily space. Why? Well, if you've seen some of our recent videos, this is because of what's going on in the debt markets for commercial multifamily. Those loans are all fixed for 3, 5, 7, or 10 years, and a lot of investors over the low rate period that just kind of started to end in 2022 took the 3-year or the 5-year money. So that those 3-year loans have all reset by now and gone adjustable. The 5-year loans were kind of right in the meatiest part of that tranche of money that has to be refinanced right now, and we're starting to probably see some of the 7-year money as well come into play. And so that's driving some of that inventory, that's driving some forced selling, that's driving cap rates up, GRM down, and pricing down in that category. Compared to the 2 to 4 unit properties, you've got owners that have 30-year fixed financing on there. If they refinance during the pandemic, they are chilling with that low 3%, even in some cases high 2% debt. There's really no distress there or reason for them to move up unless you're looking at potentially doing a 1031 exchange, because right now you can sell high if you've got one of those properties and a lot of equity, and you can buy low in that 5 and up commercial multifamily space and get an absolutely incredible deal. That's the strategy we're seeing tons of clients take advantage of right now. It's really bearing out. In a lot of cases, you can even double your cash flow depending on your situation, sometimes even triple your cash flow. Really great opportunity if you've got one of those smaller properties right now and you're playing these two sides of the market against each other. Thanks for watching. If this was useful information to you, then don't forget to like and subscribe. And of course, check out our channel for other useful videos. We've got educational stuff, we have market research, we have macro commentary, and we try not to take ourselves too seriously. Thanks.